So not too long ago, the silver market got hit with a massive shock. And almost immediately, social media just exploded with a very simple, very powerful story about why it all happened. But was that story true? Today, we're going to dig into the data behind what's being called the Great Silver Crash.
And this was the claim that just took over the internet, seen by millions. A 12% drop in a single day. According to this narrative, that wasn't just random market noise. No, this was a deliberate act, an attack orchestrated by the United States. That's a huge claim, right? And honestly, it's what sent us diving down this whole rabbit hole.
So, the story basically breaks down into these three main parts. First, that the US intentionally tanked the price. Second, that they did this to attack the so-called paper silver market. And third, that this wasn't a solo mission. It was a coordinated move, with China secretly helping out. Okay, let's unpack this, one piece at a time.
All right, first things first. Let's take a closer look at the viral theory itself. I mean, you gotta ask, what's the motive here? Why would the US supposedly want to crash the price of such a critical industrial metal?
Okay, so here's how the story goes. Silver is absolutely essential for things like renewable energy and electric vehicles. And as its price shot through the roof, it started to become a real threat to the US energy transition. The argument then is that the government, in a well-planned move, decided to engineer a crash to protect its own industries. So that's the theory in a nutshell. But what does the data actually tell us?
Okay, so to really get to the bottom of this, we have to start with the most basic question of all. Who actually controls the world's physical silver? You see, the entire narrative really hangs on this one single point. Now, the whole viral theory hinges on this idea that China controls nearly 70% of the world's silver, which would make a coordinated crash with the US possible. But yeah, the actual data, it tells a totally different story. China really only produces about 10 to 15% of the global supply. They're a huge deal when it comes to refining it, for sure, but actually digging it out of the ground, not so much. See, when you look at who's actually pulling the most silver out of the earth, you're talking about places like Mexico and Peru. And while China's piece of the pie is definitely significant, it's just nowhere near that 70% number that was flying around online. So, right off the bat, that foundational claim of the whole conspiracy, it's already looking pretty shaky. But, okay, hold on a second. The people pushing this theory, they have a comeback. They point to this one key piece of evidence. Silver inventories in Shanghai absolutely cratered, dropping by nearly 40% in just 1 year. They say, see, this was China dumping its supply to crash the price. So, if it wasn't a plot, where did all that silver actually go? Well, the answer isn't some secret geopolitical plot, it's finance. The silver flowed to London, which is the global hub for this kind of thing, and lending rates on physical silver there went through the roof. I mean, look at this. These rates are normally tiny, like 1 to 3%, but they shot up to almost 34%. That's insane. You see, a number like that creates a massive, massive financial incentive. So Chinese companies started exporting their physical silver to London to cash in on those incredible lending rates. And that's what caused Shanghai's local inventory to fall off a cliff. China then restricted exports, not to crash the world price, but to protect its own industries that were suddenly running out of silver. So it all comes down to simple economics, not some grand geopolitical scheme.
Okay, so we've tracked the physical metal. Now let's dig into that second piece of the puzzle, the so-called paper market, which gets thrown around as this big financial scam designed to keep prices down.
So this spooky paper market everyone talks about, it's really just the futures market. And, it's not some shady backroom operation. It's a standard financial tool that's used for everything from oil to corn. Its main jobs are to let producers and consumers protect themselves from crazy price swings and to help figure out what the price might be in the future. And here's the key thing you have to understand. Only a tiny, tiny fraction, like 1 to 3%, of all those contracts ever ends with someone actually taking delivery of the physical silver. So according to the theory, the weapon used to pull off this crash was a margin hike by the CME group, which is the biggest futures exchange in the world. By jacking up the amount of money traders had to have on hand, the idea is they basically price people out of the market, forcing this huge sell-off.
But is that really what was happening? Is it a weapon? The truth is, exchanges raise margins all the time when things get really volatile. It's a totally standard risk management tool. I mean, think back to 2020 when oil prices went negative, which was just wild. Margins were hiked then, too, to keep the whole system from breaking down. It's a feature of the system, not a bug.
Okay, so if hiking margins is just standard operating procedure, that already pokes a pretty big hole in the whole plot idea. But hang on, there's one more nail in the coffin for this US-China plot theory.
Because this wasn't just happening in the US. Half a world away in India, the MCX exchange did the exact same thing. They jacked up silver margins from 7 lakh rupees to 23 lakh in just 2 months. This wasn't some secret deal between Washington and Beijing. This was a global thing. Exchanges all over the world were just trying to manage this insane level of risk.
All right, let's pull all these threads together now. We've looked at the physical metal, we've looked at the paper markets, and we've looked at the margin calls. It's time to lay out the final verdict.
So let's just put it all side by side, the viral claim versus the market reality. The story was a coordinated US-China crash, but the reality is that exchanges all over the world were just managing risk. The claim was that China controls 70% of silver. The reality is they produce 10–15%. The paper market was called a scam, but it's just a standard financial tool. And margin hikes weren't manipulation, they were just a way to control volatility.
So if it wasn't a conspiracy, what did cause the crash? Well, it was a perfect storm of market forces. You had extreme volatility, real stress on the physical supply in London, standard risk management from exchanges kicking in, and a massive unwinding of highly leveraged bets all at once. It's complex, yeah, but it's how markets actually work.
And you know, that really brings us to the big question here. A simple, punchy conspiracy story, it's always going to be more exciting than a complex reality filled with data points and market mechanics. It's easier to grab onto and way more fun to share. But as we've seen, the hidden data often tells a very, very different story. So I guess the question to leave you with is this. When the next big market event happens, what will you choose to follow? The story or the data? Something to think about. Thanks for digging into this with us.